The rectangle pattern represents a consolidation of prices where buyers and sellers are equally matched, so there's movement both up and down but confined within a range. This makes the rectangle pattern a very versatile price pattern for trading breakouts. There are two main varieties of rectangles, namely the wide range and the narrow range rectangles, each with different trading strategies. Hi, this is Spencer, founder of Synapse Trading, and I've been trading and traveling across the world to teach and inspire others how to do the same. In this video, I'm going to talk about how to take advantage of the rectangle pattern to trade breakouts, how to avoid false breakouts, and the best trading strategies for this price pattern. For starters, what is a rectangle pattern and what are the two different types? A rectangle pattern, as its name suggests, is a rectangle consolidation range in which prices move about. Buying and selling forces are balanced, so prices technically break out of either direction, but there's a higher probability of prices breaking out in the same direction as the prior trend. Hence, it is classified as a continuation price pattern because it continues the movement in the same direction. There are two main varieties of rectangle patterns, the narrow range rectangle pattern and the wide range rectangle pattern. The main difference is the height of the pattern, and this has major implications. The wider the range, which is the taller rectangle, the more volatility there is and the more likely to lead to a trend reversal. And the more narrow the range, meaning the shorter the rectangle, the more likely that prices will continue in the same direction as the trend upon breakout. So what is the psychology behind the rectangle pattern? In the narrow range rectangle, the trend is taking a pause and buyers and sellers are building up their positions for the next big move, which means that there is likely to be a strong move and another leg of the trend after the breakout. On the other hand, in a wide range rectangle, buyers and sellers are not sure of the direction and are just trading within the range. During this range, there are likely to be more false breakouts than real breakouts. The main idea is to position ourselves strategically and enter the markets just as a big move is likely to happen. So how do we go about trading the rectangle pattern? There are four main trading strategies, two for the narrow range rectangle and two for the wide range rectangle. For the narrow range, we have the accumulation plus breakout and the trend pullback plus breakout. And for the wide range, we have the buy low, sell high strategy and the breakout plus pullback strategy. Now let's go through each strategy in greater detail. Our first strategy is used for narrow range rectangles, where we wait for an accumulation followed by a breakout of prices. Although a narrow range typically leads to a trend continuation, it is also possible that a trend reversal takes place, especially if the range is very long in terms of time duration. A long range can neutralize the strength of the prior trend, as the longer the consolidation takes place, the more the people from the existing trend will start to doubt the strength of the trend. In this example, we see that the volume decreases as the rectangle pattern, which is the accumulation phase, starts forming, and then sharply increases once a breakout is about to happen. As a trader, we can look to enter when the breakout happens or wait for the first pullback after the breakout to enter the market. This will get us onto the new trend right from the start. Our second trading strategy for the rectangle price pattern is to look for a small rectangle which forms in the middle of a trend and wait for an opportunity to enter when the trend resumes. As mentioned earlier, the longer the consolidation, the less likely the trend will continue. So the faster the breakout happens, the higher the probability of a successful trade. In this example, we can see the rectangle pattern form in the middle of an existing uptrend, and shortly after, prices break upwards to resume the uptrend. As a trader, we can look to enter at the breakout or the first pullback after the breakout. This will provide a low-risk entry point to ride on the next leg of the trend. Our next rectangle price pattern trading strategy is for the wide range rectangle. In a wide range, breakouts have a much lower success rate and false breakouts are more common than actual breakouts. So it makes sense to buy low and sell high within the range, and sometimes that even means fading, which is trading against breakouts and expecting the breakouts to fail. For this strategy to work, the range needs to be clearly defined, and it also needs to be wide enough so that there is enough meat on the trade, meaning there needs to be enough room for the trade to move from one end of the range to the opposite end. In this example, the green and red arrows show the buying and selling opportunities on the chart, where you can take buy positions near the bottom of the range and flip to sell positions at the top of the range. You can also use dynamic scaling at different parts of the range, such as accumulating multiple buy positions as prices are in the lower end of the range, and as price moves up to the upper end of the range, start selling off the buy positions and start accumulating short positions. Do note that eventually, after numerous false breakouts, one of the breakouts is going to be real. So when that happens, make sure you cut the position and get out fast. Our last strategy for the rectangle price pattern is a breakout from the wide range. As mentioned previously, successful breakouts are rare in a wide range. So to avoid any false breakouts, we should only enter breakouts from a wide range after a pullback, meaning we do not enter immediately upon the breakout itself. In the example above, we see price breaking down from the bottom of the range, and the first clue will be how strong the breakout is and how far it continues moving after the breakout. For trading, we will look to enter only during the pullback, which gives us a high probability and low risk entry point. Note that this large range eventually leads to a reversal, which is a change of trend direction. Next, how do we get a profit target for the rectangle pattern? Once a rectangle pattern is completed, one of the most useful things about it is its ability to provide a price projection, which can be used to estimate a minimum profit target for your trade. This can be done by taking the maximum height of the rectangle and projecting that distance from the breakout point. In the chart above, the maximum height of the rectangle is indicated by the blue rectangular box, which is then used as a price projection at the breakout point. The black horizontal arrow indicates the price level, which serves as the minimum profit target for the rectangle pattern breakout. This price projection technique can be used in conjunction with other methods such as support and resistance levels, and if there's any confluence, gives an added layer of confirmation. Here are some additional trading tips from the trading desk. Number 1, trade with the larger trend. Number 2, the wider the range, the greater the uncertainty and the bigger the risk. Number 3, when in doubt, wait for a pullback after the breakout. Number 4, the longer the pattern takes to form, the bigger the potential move after the breakout. And number 5, the wider the range, the higher the chance of a change in trend. Now I mentioned point 5 near the start of the guide, that it can serve as a useful gauge of how likely a rectangular consolidation is going to lead to a trend continuation or a trend reversal. As you can see in the diagram, when the range of consolidation is narrow, there's a high chance of the prior trend continuing, whereas if the range is wide, there's a higher chance of a reversal occurring. The reason for this is that in a narrow range, the buyers and sellers who are riding on the existing trend are mostly still holding on to their positions, and only a small minority are taking profits and waiting to enter again, so there is not much pressure to change the trend. However, in a wide range, the buyers and sellers will attempt to trade within the range, so they will sell near the top and buy near the bottom, creating a more balanced bullish or bearish pressure, meaning there is an equal chance that the trend can swing either way. If you look at continuation chart patterns like the flag and the pennant, they tend to have a narrow range, whereas in reversal patterns like your head and shoulders and double top, double bottom, they tend to have a wider range. Taking this into account, the best approach is to trade with the trend if the rectangle pattern is narrow, and trade both sides when the rectangle pattern is wide. Now that I've shared the various trading strategies for the rectangle price pattern, which is your favorite trading strategy? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe, and hit the bell notification icon to receive the latest updates. That's it for this video, and I'll see you in the next one.